Welcome to the Deep Dive. Today we're taking on the PNC Financial Services Group.
Yep, the fourth quarter and full year 2025 earnings call. This is a big one.
A very big one. Our mission today is to dig through all the numbers and the management commentary to really understand the core strategic plan here.
Right. If you follow financials, you saw the market reaction. It was immediate and very positive. We need to figure out exactly why.
We're going to decode the metrics, map out the big moves, especially with the acquisition and their capital plans, and really just give you the shortcut to understanding PNC's multi-year story.
Exactly.
Okay, let's jump right in. The big picture, the headline numbers. PNC didn't just, meet Wall Street's expectations. This was a significant overshoot.
A huge overshoot. So GAAP diluted earnings per share came in at $4.88.
And the consensus was what, around $4.20?
Roughly $4.20. Yeah, so that's a $1.68 beat.
Yeah.
So put that in context for you, that's about 16% above what analysts were expecting.
Wow.
It's one of the most substantial EPS beats we saw in the banking sector this quarter, for sure.
And the revenue side held up as well.
Equally robust. Total revenue for the quarter hit $6.07 billion.
Meeting the consensus of about $5.95 billion.
Right. But I think the real signal here was the momentum. Revenue was up a full 9% year over year.
And management really used this to frame the whole year, didn't they? They called 2025 a complete success.
They did. They pointed to record revenue, $7.0 billion in net income, and ultimately, this is the kicker, 21% full-year EPS growth. That's $16.59 a share.
The numbers don't lie. They are executing. So what's fascinating to me is that the foundation of this success, it really rests on two core areas.
Absolutely. When you look at the balance sheet, it's clear they're set up for like a classic late cycle banking scenario.
Well, let's start with that balance sheet engine. Net interest income or NII?
Okay, so NII hit $3.7 billion in the fourth quarter. That's a respectable 2% sequential increase. But the real surprise, for me at least, was the net interest margin. The NI.
It expanded.
It expanded 5 basis points quarter over quarter, getting up to 2.84%.
And NIM expansion at this stage in the rate cycle, that's a sign of really excellent management. It just means the bank is earning more on its loans compared to what it's paying out for its funding.
Exactly. And the drivers are key to understanding their whole outlook. They point to 3 things: solid loan growth, the ongoing benefit of their fixed rate assets repricing at higher yields, and this is critical, lower funding costs.
That discipline really showed up in the deposit numbers. Average loans grew 1% linked quarter, up to $328 billion. That was mostly commercial balances.
Right, what they call C&I, commercial and industrial. And deposits were also up about 2% to $440 billion, with some seasonal commercial growth in there.
But the profit lever you mentioned is that funding cost.
This is the high-octane fuel. The rate PNC paid on their interest-bearing deposits dropped a full 18 basis points, quarter over quarter.
That's a huge drop.
It poured right into that NII engine.
Okay, I have to push back a little on that fuel analogy, though.
Yeah.
Management guided for 2 Fed rate cuts later in 2026, right? July and September.
That's their outlook, yes.
So if short-term rates start falling, won't that NII expansion start to reverse? I mean, how sustainable is this whole late cycle setup?
That's the core question, and they hit it head on. They said their balance sheet is, and this is a quote, largely neutral to the timing of those rate cuts.
Meaning what exactly?
It means that while, NII growth will slow down if rates drop, their current discipline gives them a pretty big cushion. Plus, they're taking all that profitable, internally generated capital and deploying it very aggressively.
Let's talk about that deployment. So PNC ended the quarter with a CET1 ratio of 10.6%, very well capitalized.
Yep. And they returned $1.1 billion to shareholders in Q4. That was split between about $676 million in dividends and around $400 million in share buybacks.
And here's where the story takes a turn, right? This is the critical forward-looking piece, the buybacks.
This is the turning point for the guidance, absolutely.
Yeah.
Management announced they are significantly increasing those quarterly share repurchases.
So what level?
They expect to move into the $600 to $700 million range in Q1 2026. And they said they plan to keep that pace up for the whole year.
So they're almost doubling the buyback run rate. That signals massive confidence in their capital generation.
Immense confidence.
Yeah.
And it's a huge accelerant for future EPS growth.
It also perfectly complements their other big strategic move.
The First Bank acquisition closed on January 5th.
And this isn't just about getting bigger, it's strategic. They're expanding their footprint in high-growth markets like Colorado and Arizona.
Exactly. But, acquisitions always come with risk. Integration risk, What makes this deal stand out is how clearly management defined the financial goal.
They gave investors a number to latch onto.
A very clear, tangible milestone. And management explicitly said they expect this acquisition to add approximately $1 per share to their 2027 results.
And just to be clear for everyone, that's $1 of extra profit per share just from combining the two companies.
Right, from synergies, efficiencies, all of it. By the time the deal is fully baked in.
And the timeline on that is pretty quick. Full system conversion is scheduled for June 2026.
With the whole thing done by the end of 2026, the price tag for that integration is projected to be around $325 million in non-recurring costs. Most of that hitting in the first half of the year.
Okay, before we dive into the really aggressive 2026 outlook, we should probably touch on credit quality.
Good point. It's fundamental. You can't execute a big M&A deal if your loan book is shaky. But theirs is strong. The net charge-off ratio in Q4 was low, just 20 basis points.
They guided for a small increase in Q1.
A slight tick up, yeah, to around $200 million in net charge-offs, but that's still extremely manageable given their growth targets.
That strong credit quality is really what gives them the confidence to stick to their philosophy, which they basically spelled out.
They did. They gave that core thematic quote, "If you're not growing, you're shrinking."
Which justifies the heavy investment and this really bullish outlook for 2026.
And that full year 2026 outlook for the combined company is where this whole investment story just solidified. They're forecasting average loan growth of about 8%.
And you have to remember, that's combined. PNC's standalone organic growth is still a healthy 4%.
Right. The core business is still humming along.
Right.
But overall, they're guiding for total revenue to be up approximately 11% year over year.
That is a massive number for a bank of this size.
It's huge. And breaking it down, net interest income is projected to climb by about 14%, fueled by all that balance sheet discipline we were just talking about.
And that 14% is impressive because their standalone NII growth is expected to be between 7.5% and 8%. So that's already beating targets. But the other engine, fee income, is also firing.
Non-interest income is expected to be up 6%. And they gave us a great breakdown here. Mid-single digits for asset management. Mid to high single digits for card and cash management.
Plus a specific number from the acquisition.
An anticipated $100 million boost specifically from First Bank fees.
But the really fascinating insight for me was in capital markets.
I agree. They expect high single-digit growth there. And they said it's because the logjam in middle market investments finally broke open in Q4 of 2025.
That's a huge tell for the broader economy. If the middle market is finally doing deals again after being stalled by rate uncertainty, it means business confidence is back.
And PNC is positioned perfectly to capture those advisory fees. So to get all that revenue growth, non-interest expense is guided up about 7%. But that's excluding the one-time integration costs.
Okay, so let's put it all together. What does this aggressive guidance package actually mean for operational efficiency?
It implies approximately 400 basis points of positive operating leverage for 2026.
That's a standout metric. For context, positive operating leverage just means your revenue is growing a lot faster than your expenses.
400 basis points means 11% revenue growth versus 7% expense growth. And management really stressed that almost all of this leverage is expected to come from PNC on a standalone basis.
Which speaks volumes about their execution credibility.
It does.
So how are they funding this huge investment, slate tech, payments, rewards, branches, while still delivering that kind of leverage?
That is where their continuous improvement program, or CIP, comes in. PNC has an annual target of $350 million in cost savings from this program. It's separate from the acquisition.
It's like a perpetual cost-cutting engine that funds growth.
Exactly. It's funding their ambitious tech roadmap, which includes a 10% plus increase in tech spend in 2026. And get this, artificial intelligence accounts for 20% of that increase.
They have a track record here, too. They said previous automation efforts delivered 40 points of operating leverage in their retail operations just between 2022 and 2025.
And they expect another 40 points of leverage from automation going forward. It's a very disciplined model.
So moving to the bigger picture, management was really keen to reframe the company.
They were. They made a very firm distinction. PNC is a national bank, not a regional bank.
And that's a crucial point. It's basically them saying that to survive long term, you need the scale to compete everywhere in the U.S. against the mega banks.
The question then becomes, can you generate the returns of a mega bank?
Right. And that brings us to return on common equity, or ROCE, the key metric for bank profitability. PNC exited 2025 at about a 17% ROCE.
And management expects to exit 2026 at 18%. and heading higher. Now, they were careful to say ROC is an outcome, not a strict target, but they highlighted that the mechanical outcome of their current plan points toward 20% ROCE in the not-too-distant future, assuming, of course, that credit costs stay low.
20% ROCE is a level typically reserved for the absolute industry leaders.
It is. And their macro outlook supports this. They're forecasting continued economic growth, about 2% real GDP, and those 2 Fed cuts in the back half of the year. It's just a very powerful multi-year growth story.
All right, let's pivot. Let's build a high conviction thesis for you to consider. We acknowledge the incredibly strong guidance and the clear path for 2026. The market has priced in some of that, but we're looking for an outrageous but plausible pitch.
Right. And given the clear math they laid out, that explicit $1 per share synergy in 2027, plus the internal math pointing toward that 20% ROCE long-term, the market might still be underpricing the longevity of this story.
They might be underpricing the management team's ability to execute.
Exactly.
So if you believe in the flawless execution of this whole roadmap, what's the specific trade?
Okay, so the trade is a long position in deep in the money 2027, or maybe even 2028. Long-dated call options.
A long-term bet.
A very targeted long-term bet. You're wagering on the flawless delivery of 3 critical levers. First, the full timely realization of that $1 synergy. Second, the sustained delivery of that 400 basis points of operating leverage.
And the third?
The continuation of that significantly accelerated $600 to $700 million quarterly buyback program, which just turbocharges EPS growth and pushes ROCE past 18% and decisively toward that 20% ambition.
That is a high conviction wager on operational execution.
So what does this all mean for you? Look, PNC delivered a massive beat. They laid out a very clear path for 400 basis points of positive operating leverage for 2026. And they gave you a specific dollar-based milestone for the first bank integration. It's a credible, aggressive roadmap.
And here's a final provocative thought for you to chew on. Management used the phrase mechanical outcome to describe how their plan could push ROCE north of 20%. So what would need to happen in the credit environment for PNC to actually achieve a performance level that you typically only see from the mega money center banks?
If they can keep credit stable while executing this M&A plan, their national bank vision, it becomes a reality.
We hope this deep dive has given you the key insights from the call.
We'll catch you on the next deep dive.